Thanks for joining us today on Market Call. I'm Morella Fernandez. Stan Wong on the show with us today, portfolio manager at Scotia Wealth Management, taking your questions on North American large caps and ETFs. Here's how to reach us. 1-855-326-6266. You can email your questions in as well. Market Call at BNNBloomberg.ca. Stan, good to see you. Thanks for coming in.
Thank you. Great to be here.
North American markets are on a bit of a tear. The S&P, the NASDAQ pushing higher all the time. Where is this enthusiasm coming from?
A lot of it is just really earnings. I mean, when we look back a few months, earnings estimates were not quite as high as they are today. We're pointing at around 20% earnings growth for the S&P 500 this year and a forecast of 14% growth for next year. So really earnings have pushed this. What a difference, a month or two makes. I mean, in March, we were worried about the geopolitical events that were happening around the world. And really, right now, markets are trading through that fear and not really collapsing underneath it and making record highs with the Dow hitting 50,000 this morning and so forth. So, it really underscores the fact that the short-term geopolitical shocks tend to be short-term, and really it's earnings and fundamentals drive markets.
Investors, do you think, are realizing, I just made up a word there, the benefit of AI, or do you think a lot of that tech movement is just about the shortages?
I think it's a combination of the two. I think this is really a story about CapEx spending and just a new spending cycle via AI, digital infrastructure, electrification, nearshoring and reshoring trends. Those manufacturing trends are also big as well. So it's really not just an AI trade. It's really a capital spending cycle that is accelerating at this point into the physical economy, away from just like the chips and code and software.
What could be a headwind to the economy? You mentioned that investors are looking past geopolitics, the conflict in Iran being one of them. What do you see as a possible headwind to the economy then?
Well, I think we're probably a little bit overbought technically, so we could be due for a pause at some point. Obviously, if energy prices oil remains above $100 for a sustainable period of time, that can cause inflation to ratchet up a bit. Geopolitical events obviously can cause a new concern. And then, of course, we have U.S. midterm elections in November coming up. With that being said, we know that the third year of the presidential cycle, which is next year, is your best year of the 4 years. That sort of that after effect of the midterm elections tends to be a very strong period for markets. The 1 year or even the 6 or 7 months after the midterm elections tends to be very, very strong.
Do you think the energy prices, which have been up, will weigh down some of the earnings next quarter?
Inflation has ticked up a little bit. It's hard to say because we need to understand how long will energy prices remain this high. But when you look at futures markets, we're looking at around the $70 to $80 mark by the end of this year. So if those futures markets are correct, then we'll have an easing in oil prices, which should continue to help markets.
Okay, let's take a quick break then. We will get to the first phone calls for Stan Wong of Scotia Wealth Management. Again, he's taking your questions on North American large caps and ETFs. Here's how to reach us. Back in a moment. Welcome back to Market Call. We have an email from Ash. He said, would you buy Novo Nordisk right now? Does the company have many other drugs in its pipeline besides its weight loss drug? We turn that question to Stan Wong today with the question about pharma and the weight loss drugs, much more competition in the space.
There certainly is. In this space, the pharma space, I prefer Eli Lilly, which is in our portfolio. Novo Nordisk, I think there is a broader pipeline story, but the large majority of the revenues is coming from the weight loss and diabetes areas. It's still a very high quality franchise, but I think expectations are resetting a bit lower in the market. As you can see, the chart is showing some weak technicals with the 200-day moving average trending lower and the price below that as well. So, technically it's a tough stock to be looking at this point. When you look at earnings growth, we're only seeing about 3 to 4% earnings growth over the next few years. So from an earnings growth story, that's probably not a place we want to be at this point. So I think that long term it'll come back, but for the time being, the stock is telling us that we want to be cautious.
Let's get to the first caller then. We have Scott on the line in Toronto. Scott, go ahead.
Yeah, Yes, Stan, thanks for taking the call. Is now a good time to take a position in McKesson Corporation? Thank you.
Thank you for the question. So they do sort of medical surgical supplies?
They're more in the logistical space. So, there's three companies, Cencora, Cardinal, and McKesson, that control the pharmaceutical logistical market. So they would move the drugs from Pfizer to Walmart or Walgreens or whatnot. We own this particular name alongside with Cardinal Health. It's been a great long-term performer for us. More recently, there's been a bit of a rotation outside of the healthcare space into more exciting areas. So healthcare's kind of come off a little bit. I still see, a 12% earnings growth, 12 to 13% earnings growth for this name. You're paying about 17 times forward earnings. It's just a tad below the 200-day moving average at this point. So, just a little bit concerning for me. But I think it's just the rotation out of the healthcare market into the more cyclical areas, including technology and so forth, that's hurting a name like this.
That was Scott. Let's go to an email from John in Picton, Ontario. Can I please get your guest views on Booking Holdings, Inc.? It has dropped 30% since it split. Is this a good time to pick this stock up? Stocks like Booking, are there AI concerns around this kind of business?
There is. I mean, if you think about AI agents, that's the real concern to companies like Booking and Expedia. Expedia is a name that we own in the portfolio. Booking is not. Expedia has performed a bit better, just a better platform in terms of their earnings and so forth. So with Booking, I see that the 200-day trend line is now starting to move lower, and the price is below that at this point. So from a technical perspective, it'd be difficult to want to buy that stock at this point. With that being said, I think that long-term, the secular growth of travel with aging demographics and just the change since COVID that people can work remotely. There's more travel there. Of course, business travel has declined, but leisure travel has stayed very high. We still see 16% earnings growth from this particular name. But in this space, I prefer Expedia just for some of its growth and valuation prospects. Because,
as you mentioned, there is an AI concern, would you put new money in to either of these today?
I like Expedia. Expedia's chart is looking a little bit more attractive. The 200-day moving average is still moving higher. There's still that overhang of, what's going to happen with AI. But I think that with both these names, they're going to use AI they're using AI to improve their platforms as well to figure out what customers want and to make things more efficient. So I think it's a bit of a double-edged sword that AI can have a negative effect, but I don't think it's a tomorrow story. I think that might be over time, and the jury's still out on that.
Let's get to the next phone call then from Ray in Hamilton, Ontario. Ray, go ahead.
Oh, yeah, thanks for taking my call. Yeah, Stan, I just wanted to get your opinion on Barrick Gold. Thanks very much.
Okay, thank you for the question. So Barrick has a spin-off coming up of North American assets. What do you think about their idea of spinning off North America?
I think that if they can extract value of their shares, they should certainly do that, and I think it can help the shares. With that being said, I mean, gold and precious metals have moved so far, so fast. My preference, as I'll talk about in the top pick segment, is to move to base metals because base metals is more tied to the AI story and the theme of nearshoring and reshoring and supply chain movement. With that being said, Barrick has performed extremely well with the 200-day moving average moving higher. I do see a little bit of lower lows and lower highs since earlier this year, very, very short term. But again, my preference would be to look at some of the base metal miners rather than the gold miners.
Okay, let's go to an email from Brian. He says, what is your expert opinion on Great West Life, GWO, buy, sell, hold, and do you own it? Do you own anything in the space?
Right now, we have nothing in the insurance space. We actually sold off some of our insurance names in the last quarter or so. But Great West Life technically looks very strong with the share price hitting new highs and the 200-day moving average continuing to move higher. I think when you look at the insurance space, you're getting stable earnings and relatively cheap valuations. And with Great-West Life, you're getting a 3.5% dividend yield, which we suspect will continue to move higher. So I think it's a very sturdy name. We like the insurance space in general, but some of these names have kind of ratcheted up a little bit faster than we'd like to see. And, with the rest of the market, I think things are a bit overbought right now. So there might be a better opportunity to look at a name like this.
Is that why you pulled out of insurance recently?
We took our profits out of names like Sun Life and Manulife.
Okay. Let's take a quick break on that note. We'll be back with Dan Wong of Scotia Wealth Management, taking your questions on North American large caps and ETFs. Back in a moment. Welcome back to Market Call. Mike has written in he would like to get Stan's opinion or view on Dollarama. We thank him for that question. Dollarama has been doing a lot of expansion. You would imagine in tougher times when people are spending more on energy, perhaps they want to spend less on other things. What is your take on Dollarama?
We continue to hold the name in our portfolios. We've done very well long-term with it. Of course, lately it's been a bit of a sideways, slightly downward movement. I still think of Dollarama as the dominant discount retail model in Canada. We really can't think of another name that really competes well against Dollarama. And you're right, there is defensive consumer positioning whereby consumers are being more value focused with energy prices being higher and a little bit of softness in the Canadian economy. So I think those things still bode well for a name like Dollarama. And of course, that runway of more expansion should help revenues and margins down the road. I think the real issue is valuation at this point. Mm-hmm. That is the main issue. The stock is no longer considered cheap. And I think that it's a very strong company. But right now we're looking at valuation for this company. So the quality is not questionable. It's really how much good news is priced into the stock at this point. And
valuation, it's in its 30s, 36, something like that?
Yeah, it's in 34 times next 4 quarters, okay. PE.
All right, let's go to the next caller then. Jim is in Oakville. He has a question today. Go ahead, Jim.
Hi, good afternoon. I enjoy your program, young lady. Thoroughly enjoy the way you handle it. And Stan, thank you. You usually earn me money, but today you'll cost me money. The drop in Manulife, and a substantial amount in Manulife, is absolutely massive and doesn't seem to affect Sun Life. Any reason why? I'll hang up and listen to your reply. Again, thanks, Stan, for your previous information, but it was always good.
Thank you. What's going on with Manulife?
I think that, again, with the rest of the financials in the TSX, we see financials, including Manulife, perform well. See a bit of a drop there. I actually don't know the news around the recent slight drop from 55 down to where it is today, 51. And so with that being said, I think the chart still looks pretty intact. The 200-day moving average looks very, very intact. You're getting a very nice dividend from this particular name. Again, like much of the market, we've got to be careful of overbought situations. And Manulife isn't quite overbought at this point. It has fallen a little bit, so it's become a little bit more.
Yeah, earnings per share, I guess, was down for the latest report.
Yeah, I see that now. Yeah, so there's a bit of concern over the earnings at this point. With that being said, we still see double-digit growth going forward. A miss on the one quarter is one thing, but I think on a secular basis, we'll still see going forward 2027, 2028, 10 and 11% earnings growth. So it's a steady earner, and you're getting a very, very nice dividend. Again, you just got to watch the charts at this point for entry points.
Let's go to an email from Jeff then. Jeff is in Maple Ridge, BC. He says, hi, Stan. Could I get your opinion on Waste Connections? I recently initiated a half position on the most recent pullback. I'm a long-term investor with 20-plus years looking at for a time horizon. So Waste Connections, obviously a steadier business, I imagine, as well.
Very steady business. However, the stock is not looking steady with the 200-day moving average trending lower and a series of lower lows and lower highs at this point. So I think, again, the market is sort of looking around and looking at the more exciting plays in the technology, the industrials, and so forth. And I think that's what's affecting this type of name. Fundamentally, I think it's sound because it's, how much more stable can you get from waste management? Mm-hmm. We see 10% earnings growth going forward, paying up a little bit at 27 times forward earnings, and maybe that's having an effect on the share price. But just based on the technicals, it'd be challenging for me to start a position because we like to buy things where the moving averages are moving higher and the price is, firmly above that moving average.
So you'd wait and watch on this one?
I would definitely wait and watch on this one.
Let's get you another email from Mary in Nanaimo, BC. May I please have your opinion on Vanguard's FTSE Emerging Markets All Cap Index ETF, so VEE. I need some foreign investment and it looks interesting. It seems to have a very low PE and price to book ratio. And again, that's Mary. Can you tell me a little bit more about this one?
Yeah, certainly. This is basically a basket of emerging market regions, including China, Taiwan, India, Brazil. The one thing I would say, and I think you're the viewers on the right track to expand beyond North America and look at places like emerging markets because they have been performing well and in many cases are outperforming North American markets. With that being said, the one thing I would look at here is with this Vanguard strategy, it does not include anything in South Korea. South Korea is not defined as a position in this particular ETF. So I would say that you want to look at other spaces that give you that emerging market, that South Korean space. And that would be the iShares one would be one example. XEM would include the South Korea exposure.
And why do you think South Korea is so important?
Well,
right
I
now?
think, with Samsung and some of these names that are in South Korea, that's really a huge growth hub and a lot of innovations happening there. So I think if you're going to buy emerging markets, you're going to want to have that exposure to South Korea. So EEM, which is XEC, EEM's the US version of iShares, they have about 22% in South Korea, and I think it's important to have that region there.
Just wondering whether, because it's at a high today, whether you would wait for a pullback. Is this something, is it a volatile ETF where you could expect a pullback and to get in?
Yeah, generally speaking, emerging markets would be a higher beta type of move. Just in March, it went down with the rest of the market down to the 200-day moving average. That would be a fantastic time to purchase it. With the RSI at 62 today, which is getting close to overbought, I'd probably hold off and maybe wait for the 50 levels to enter a name like this. But again, I would consider the iShares versions before this.
Let's take a quick break then. We are going to be back with past picks from Stan in just a moment. Stay tuned. Welcome back. Time to go through some past picks from Stan Wong from May 7th of last year, so just over a year ago. At the time, he chose iShares Core MSCI. This is the ETF for that includes Asia. It's funny, we were just talking about something similar. And I'm looking at where it was last year, 79.72 US to 97.03 US today. So that's 22% upside and 26% total returns. Do you remember why you chose this at that time last year?
Yes, basically broadening into international markets because we've started to see international markets start to wake up a bit compared to the U.S. We've seen the U.S. outperform for a decade versus international markets, but now we're seeing a little bit of a reversal, partly due to the fact that the U.S. dollar is starting to weaken a bit, so we're seeing international markets perform again. I like Europe, I like Asia, and I do like the emerging markets as well. With this ETF, you're only paying, I think, a 7 basis point expense ratio, and you're getting exposure to international markets in Europe and Asia. Definitely, for some time now, international markets are more attractively valued than U.S. large cap or even just the broader U.S. market. You're getting more exposure. So in the U.S., if you're owning the U.S., you tend to own a lot of mega cap technology and large cap, probably 50% or more if you're buying the SPDR, the S&P 500 index. With this particular ETF, you're getting exposure to other sectors, which is important, like financials, industrials, and more dividend payers. There's more dividends in this particular market as well. So really, I think that over the past while, the U.S. mega cap technology has been the main act. but international markets gives it exposure to the rest of the global stage. And that is important because if you look back 30, 40 years, the U.S. hasn't always been the dominant place to be. There are times in which international markets perform better than the U.S.
And do you like investing in ETFs for international markets as opposed to specific stocks?
We have both. So we tend to have individual names, but this particular ETF gives us a very broad and wide brush into that area.
Okay. Let's get to your next past pick, Mercado Libre, MELI, on the NASDAQ at 2,267.09 US. Again, this was last May, down to 1,557.07, so 31% down in return. Same for total return. What happened here?
Yeah, very challenging name. We still hold it. That secular growth story is still intact. It's still one of the strongest long-term growth stories globally, despite this recent volatility. If you look at the latest quarter, revenue jumped 49% year over year. The reason why the stock has really lagged is that they are putting heavy investments into logistics and shipping and fintech and credit expansion. So you think of Mercado Libre as Latin America's Amazon plus PayPal combined. But they're putting a lot of money into strengthening for the long term. So the market is definitely focused on margin pressure today, but Mercado Libre is really building the dominant digital economy for long term in Latin America. So we still like this name. We still see double-digit growth from a name like this. I think it's still close to 20% growth rate or more going forward for Mercado Libre over the next few years. So actually, no, it's 39% is what I'm seeing. So very strong growth.
Okay.
We're paying 36 times forward earnings. But, the sentiment is kind of rough on Mercado Libre. The chart's looking a bit rough. But I think that this is going to be one of those cornerstone names long term.
Is that indicative of the consumer in some of these markets in Latin America?
I think it's really just the company is spending on logistics and improving, just like DoorDash is doing some of those things, and the stock price went down. They're short-term pain for long-term gain is the way I would put it.
Okay. Let's get to your past pick, your third one from last year, which is Visa, just V on the New York Stock Exchange, 349.85 US to 321.47, 8% downside, 7% total return. Visa, MasterCard have been going kind of sideways for a while.
Yeah.
I know a lot of people have larger positions in this. It's done so well historically. What's weighing on it?
So for disclosure, we are out of Visa. We hold MasterCard. We sold MasterCard about 4 or 5 months ago. We're out of the name. I mean, both these names are elite businesses, but momentum is broken clearly based on the charts. Visa the price is now below the 200-day moving average. A 200-day trend is also rolling over at this point. At the end of the day, the secular growth aspects of these names, you got powerful global payments network, high margins, recurring transaction revenue. But it's, again, I think it's just more about valuation at this point. And again, switching to, if you think of Visa and MasterCard as a tech, I know some people think of it as a financial. Mm-hmm. If you think of this as a technology, there's a lot more exciting technology names. And I think that's what's impacting names like Visa and MasterCard. They're moving to more exciting technology names. If they think of Visa in the technology bucket, I think long term the secular growth from moving from cash into digital payments is going to continue, but it seems like the stock is in the penalty box for the time being. So we're out for now. I can certainly see looking at this name again when the technicals improve, but right now we're out of this name.
So it definitely sounds like there's a lot of fear of missing out, right? People are abandoning what traditionally they might invest in because they see a lot of growth. They want to get in on that?
Yes, I think so. I think that's part of the story. I don't know for certain, but I do see that there's a rotation in the market to higher growth type of names within the tech space and the industrial space and so on. Visa is still looking to provide about 14% earnings growth, so it's still very strong growth. And we see that where the growth story is still there, but it's just not exciting enough, especially when you compare it to the fact that you're paying 23 times, which is actually not historically very expensive for Visa.
Okay, let's take a quick break. Zan Wong with us of Scotia Wealth Management, taking your questions on North American large caps and ETFs. We'll get to your questions when we come back. Let's go to our next caller. Doug's on the line. He's in Lindsay, Ontario. Doug, go ahead.
Your opinion on Canoe, GEIT Income Fund, TRUT?
Okay, we'll have a look at that. Is this one you know well?
I know it. It's basically a basket of dividend payers in both Canada and the U.S. Some of the top holdings would include a lot of energy names like Tourmaline, Tourmaline, Prairie Sky, and so forth. That's the energy space is one of its largest holdings. You're getting a pretty high yield, but I believe some of that is return of capital. So the yield is a little bit misleading, in my opinion, because I think it's showing around 6 or 7% yield. Some of that's a return of capital. So for income investors, as long as the stocks within this particular name does well, then you'll see that yield being fine, and it shouldn't have an erosion on capital. But that is the wild card, is that if we see a decline in the market, that's going to have an impact. So looking at the sector allocation, you've got about just under 30% in energy, just under 30% in industrials. It's very different from holding, say, the TSX, because that would be mainly financials and energy. So there's a bit of a diversification there. So it really depends on the investor. Certainly the track record has been great, well managed, but you just got to watch out for the yield in case markets start to soften.
That was Doug. Let's go to Michelle in Vancouver with her question. Michelle, go ahead.
Hi, Morella. Can I get Stan's thoughts on JP Morgan? It's been a little flat recently. Do you still like this stock for the long term? Thank you.
Thank you for the question. Can I get your thoughts on financials in general? As we mentioned, a lot of people are looking for tech, looking to get in on tech or industrial build out. How are financials doing? And JP Morgan, what do you think?
So first off, we do own JP Morgan in our strategy. I like the name. You're getting a 2% yield. I think that you brought it out to the financial space. Capital markets are improving. Markets are improving. So you'll see more investment banking fees come through. We see more deregulation happening in the U.S. And just in general, I think the consumer is not going to be as bad off as many kind of was worried about. So I think the financials is a good place to be. So far this year, it's been a little bit of a laggard compared to the other sectors. So that could be a case to start looking at this space. It's actually, year to date, it's actually the worst performing sector relative to the other 10 sectors. So I think there's a lot of value in this particular area. I like them. I like the income coming from financials, U.S. financials. So it's definitely a space that I would continue to add to.
Okay. Let's get to Andy then in Calgary with a question. Andy, go ahead.
Hello to the both of you, and thank you for taking my call. Stan, I wanted to know about General Mills. I know not just General Mills, but this sector, food industry, hasn't done very well for the last couple of years. Is there some value to be had? And is General Mills a good way to play that? I'm just interested in your thoughts. Thank you very much.
Thank you for the question. Would you put General Mills in sort of the staples category?
It would be in the consumer staples category. Like some of its main brands would be something like Betty Crocker and some of the names that we know at home and so forth, and Pillsbury and so on. But when you look at the stock pattern and the technical patterns, it's very weak. 200-day moving average has been falling for quite some time. The price is well below that. So as a rule for us, I mean, this has been the 200 days has been falling since 2023. Moving average has been falling since then. So, from our discipline, we wouldn't buy stocks that are, well below the 200-day moving average with a falling 200-day moving average. And then fundamentally, it actually looks like General Mills will have losses going forward of about 8% earnings decline, negative earnings growth over the next few years. So wouldn't really fall into our area. I don't think that there's really a value play here, because for value, you need not just a low PE and low metrics, but you got to still have growth. And this company doesn't show that at this point. Maybe at some point it'll get so cheap and it'll start to turn around. But I note that even target prices from analysts are pretty low relative to where it is today.
Do you think this is just sort of consumer sentiment at this time? A lot of sort of processed foods are not in favor, that kind of thing?
Yeah, that's a good point. There's a change in sentiment from consumers. There's a change in sentiment in the markets. Why buy a consumer staple name like this when you can own Amazon or you can own NVIDIA and so forth? And then I think the other thing that's impacting names like this is input prices. Input prices have been going up around the world. Inflation is not just impacting you and me, but it's also impacting producers like General Mills.
Let's get to the next caller. Then we have Al in Montreal. Al, go ahead.
Thank you very much, Stan, for taking my call. I'd like your opinion of a Canadian general ETF covering the Canadian market, and one I was considering was XIC. So I would like your opinion on that, if there's something better that you would request.
Okay.
Thank you.
Thank you for the question. Can you tell me about this one a bit?
Sure, it's just a basket of the TSX holdings, and you would have your, normal large cap names such as Royal Bank, TD Bank, Shopify lead the list in this particular index. Performance has been strong because the TSX has rebounded quite nicely in the last year, and you're getting about a 2% dividend yield from this particular area. So with a basket that is really mimicking the TSX, of course, you'll know that you're basically really overweighting financials and resources, namely energy in this space. So you want to make sure that that's within an investor's risk tolerance. In the TSX space, I prefer something like XEI, which deliberately looks for names that are in the higher yield space, XEI in Canada, or VDY, which is Vanguard's FTSE Canadian index, which is also a high yield type of space. And it'll probably diversify you a little bit, but XEI is more diversified than VDY, and it'll be more diversified than XIC.
All right, let's take a quick break. We're going to be back with Dan Wong, Scotia Wealth Management. He's taking your questions on North American large caps and ETFs. We're back in a moment. Welcome back. Let's go to a caller. Capel is on the line in Oakville, Ontario. Go ahead, Capel.
Hello. I would like to get Stan's thoughts on memory chip companies. Mainly, are they truly cyclical or structural? And one of the names I'm looking for is Downhill Memory ETF that holds Micron, Samsung, primarily, and SanDisk as well. I know it. Some people argue that the price to earnings is pretty cheap still. There is a long way, runway to go. Want to understand from the cyclical versus structural piece, so that I know when to exit. I know it may not be an easy answer, but just looking for some thoughts. Thank you so much.
Okay, thank you. Can you speak to that?
I think we're talking about the DRAM ETF was what the question was. So the DRAM ETF is a brand new ETF, just came out very, very recently. It's basically a basket of memory companies such as SK Hynix, Samsung Electronics, SanDisk. SanDisk is
yes.
One of these names have really powered up in the last year or so and has done well. But I would note that in 1 month, DRAM ETF is up 62.5%. So I think in any case, you've got to be very careful of this ramp up in any ETF or stock price. There's going to be profit taking. There's going to be some valuation resets and so forth. So RSI, very tough to sort of look at RSI because it really hasn't been around for a while.
It's only been in about a month old, we'll say?
Yeah, a bit more than that.
A little bit more than that?
But the 1 month return is 60-something%. So I would say, and you're paying 65 basis points for this ETF. I certainly think that the memory space makes a lot of sense, and it ties into the AI build out and so forth.
The shortages, sure.
But when something goes up 65% in 1 month, I'd be very cautious of that if you don't already own it.
So do you feel like the memory shortage will last for some time? We're hearing a lot of the providers saying, they have a lot of interest, they have a lot of backlog. Do you feel like it could be something that exists beyond 2026, even to next year?
Yeah, that backlog is real, but are we overpaying for it today? And that's the question that we see with a name like SanDisk and SK Hynix and Samsung. So I'd be cautious on that. Whenever we see this sort of exponential move in any name or space, we're very careful of that. And I'd rather be taking profits than jumping in at the the end of the train there.
At the highest point. Okay. Let's go to our next caller. Wendy's in Dundas, Ontario. Wendy, go ahead.
Thank you. I have some U.S. Cash to invest. I have U.S. Financials, energy, utilities, etc., but I have nothing in the technology sector. I was looking at Microsoft, and I wonder if I could have your comments on that, please, and if not Microsoft, anything else that you might suggest, and a good entry point. Thank you.
Thank you for the question. Yeah, Microsoft is really off. I know a lot of them have been reporting. NVIDIA is still to report. And people seem to be deciding who's winning the AI race. Microsoft, as a software company, seems to be still a little out of favor. What are your thoughts?
So, earlier this year, the concern about the hyperscalers, including Microsoft, is, wow, we're spending $700 billion, or they're spending $700 billion, or 750 could be the number this year in CapEx, which is more than anybody thought. Now, names like Alphabet and Amazon have actually performed okay after a little bit of a downturn. Microsoft is still below the 200-day moving average, and the 200-day moving average, I believe, is still trending lower. Now, certainly, Microsoft is an elite artificial intelligence cloud franchise with its Azure platform. I think they'll have real artificial intelligence monetization going down the road. But I think that the bar for execution is very high at this point for Microsoft. I think that the spend that they're going to spend this year is tough. When you look at names like Alphabet or Amazon, they have things beyond the cloud side, and so does Microsoft, but not as of significance compared to or diversified like a name like Alphabet or Amazon. So I think there's a really soft technical entry point at this point that I'd probably be careful of. We did own this name. We sold it a while ago. I think it's an excellent long-term business, but I don't think the entry point is very clean at this point. And I think that valuations are a little bit tough when you compare it to some of the other names out there. Microsoft, we still see very strong earnings growth, 18% earnings growth. But, I think that's a theme for today. We're seeing names that are not performing still has good earnings growth, but the market's just rotating to other spaces. I see that price of sales, it's at 8.2 times going forward. It's not unreasonably valued at this point, but I think we got to pay attention to the charts.
So would you recommend another one for her if Microsoft is not necessarily the strongest play?
Yeah, in our space, I mean, I like Taiwan Semiconductor in our portfolios, I should say. I like Amazon, which is technically consumer discretionary. I like Alphabet. Those are names that I prefer, and we'll talk about another one in the top picks. I won't give that away just yet.
Okay, let's go to Frank then in Toronto. Frank, go ahead.
Hi, Marilla. Hi, Stan. Thanks for taking my call. I was wondering, I've been following two ETFs, ZQQ and ZUE. One's the NASDAQ and one's the S&P 500. What do you recommend? Do you recommend any of them? Which one do you prefer over the other, or do you have one of your own? Thanks very much. Bye.
Can you do a bit of a comparison between the two?
Yeah, so the S&P 500 is obviously the 500 space, but the thing about that is you're going to probably get around 45 to 50% in technology and communications, which is pretty much what the triple Q is. It's got some biotech in there as well, of course. But we think of triple Q as mainly technology names with some consumer discretionary, some biotech, pharma, and so forth. But we would think of that as mainly a technology / communication space. Of course, this area has done well. QQQ is up 39%. The S&P has done very well as a result of some of the technology names in there. But I'd just be cautious about how much exposure do you have in tech in the other parts of the portfolio. If you don't have any, then cubes can make some sense at this point. But remember that this space has done so well.
Let's take a quick break. We're going to have new picks from Stan Wong when we come back. Stay tuned for that. Join us tomorrow for Market Call. Eric Nuttall on the show, partner and senior portfolio manager at 9 Point Partners. He'll take your questions tomorrow on energy stocks. Let's get to some new picks from Stan Wong. We're going to start with NVIDIA, which has been doing very well. I think it's record high today. Would you put new money in even today?
I like it, but as I've been saying the entire segment, like a lot of things are overbought at this point. We've had a major recovery since the March lows. So I'd be cautious on how you sort of weigh into these particular names. But I do like these names fundamentally. I think that they'll do well after, going forward 12, 18, 24 months. NVIDIA is a name that we've held for some time, and I continue to think that it's relatively cheap relative to other growth stories out there. Clearly a leading AI chip and systems company that provides much of the computing infrastructure that's needed behind AI systems today. They are considered the brain or the arms dealer of the AI build-out, and they'll be considered that for a long period of time. If you look at what's happening with the major hyperscaler companies this year from technology companies, they're going to spend $700 to $750 billion. And we want to see who's going to benefit from that. And that is names like NVIDIA and Taiwan Semiconductor and so forth. So that money that's being spent on CapEx is going to names like NVIDIA. We see $370 billion in fiscal 2027 revenue projected for NVIDIA. Earnings growth forecast going forward the next few years is 45% a year. That's the forecast now. PEG ratio is sitting around 0.6 right now. That valuation is very attractive compared to other growth names out there. So you think of NVIDIA, they're really selling the picks and shovels of the AI gold rush. And I can compare them to an Apple type of company. They have the ecosystem. They're not just about the hardware. They're about the software through their CUDA software platform. They are supplying an ecosystem that consumers can't really get out of, just like Apple users can't get out of their ecosystem of iPhones and the Mac and so forth.
All right, NVIDIA as your first pick. Let's get to your next one, which is GE Vernova. GEV in the New York Stock Exchange, also a company doing a lot of the heavy lifting in this space we're in right now.
Yeah, so new highs again for this name. I like this name a lot. It's basically the power generation and grid infrastructure company with major exposure to steam and wind turbines, grid equipment and electrification systems. So AI is not just a coding software story, it's about electricity. And that's very important for names like GE Vernova. If you look at US data centers through 2030, they will drive about half of the electricity demand growth from now until then. US data centers. So if you look at GE Vernova, they're a direct beneficiary of that particular name. That's a really direct way to invest in the power side of AI and electrification. We're seeing about $45 billion in revenue expected for fiscal 2026. GE Vernova's got a backlog of around $160 billion, so roughly 4 years of revenue. You know, you call them today, they can't supply you anything until 4 years later. That's a really great position to have for a company. So if you think of NVIDIA as the brain of AI, GE Vernova is the power side of AI.
And you definitely have no concern putting new money in today, despite the spike it's seen.
Again, you know, things are overbought, so maybe weigh into some of these names I discussed today, just like we are, because things are overbought. We have midterm elections coming up. There's going to be some volatility at some point. You know, find a price that makes sense for, you, the individual investor, and move into it at that point.
Let's get to your last pick then, which is Invesco DB Base Metals Fund, so DBB in New York. Can you tell me what's part of this?
Yeah, so this is basically a physical commodity ETF in the base metals side. So it's basically 1/3 copper, 1/3 aluminum, and 1/3 zinc. This is also a direct play on electrification, infrastructure, and the industrial rebuilding. The benefits from nearshoring and reshoring means that you need more steel, you need more electricity, and so forth. They're basically the physical build-up behind AI and power systems and new manufacturing systems. So very essential, these metals for power grids and renewables and data centers. We see improving momentum in base metals, especially compared to precious metals, which has been the story going back a couple of years. And I would look at it as AI and electrification are not just digital markets or digital stories, they're metal-intensive stories as well. You cannot build grids or factories or data centers without base metals.
Okay, and you look at this sort of three-way of playing it, you get all three of these metals in one.
Yes, absolutely.
Okay. Stan Wong, got to leave it there, sir. Thanks for joining us.
Thank you.
All right, and thank you for joining us today on Market Call. We'll see you back here again tomorrow.